There are moments in financial history when a single document changes everything. Not a headline, not a rumor, not a price chart, a document. Something written in private, never meant for the public eye, that reveals how the system really works. And today, we're looking at one of those moments. Because according to a leaked email chain, a decades-long silver manipulation may be reaching its final stage, and the people at the very top of the financial food chain may have known about it more than a decade ago. The email that shouldn't exist. The story begins in 2011. At the time, silver had just surged toward $50 an ounce. Markets were volatile. Confidence in the financial system was shaky after the 2008 crisis. And behind closed doors, a private conversation was taking place, an email exchange between Jeffrey Epstein, Ghislaine Maxwell, and a French banker referred to only as Bernard. Now, forget the headlines you've heard about these names. Focus on the content of the message. Because what Bernard allegedly wrote is what matters. He wasn't talking about rumors. He wasn't talking about charts. He was talking about the structure of the silver market itself. And what he described was explosive. The smoking gun statement. In the email, Bernard reportedly wrote, "A squeeze is possible if one can take delivery of 100% of the futures contract." Let that sink in. Because that single sentence tells you everything. What he was describing was a fractional reserve system, a market where far more silver is promised on paper than actually exists in physical form. In other words, the system works. Only as long as most participants never ask for delivery, but the moment enough people demand real metal, the structure breaks. This wasn't a conspiracy theory on an internet forum. This was an insider, a banker, explaining the mechanics of the market to elite clients, and he didn't stop there. The $150 silver prediction. In 2011, in the same communication, Bernard allegedly estimated silver's inflation-adjusted value. His number, $150 an ounce. And remember, that was in 2011. If you adjust that figure for today's monetary expansion, it implies something far higher. Many calculations place that equivalent well above $500 per ounce in current dollars. Think about that. While silver was trading near $50 at the time, insiders were allegedly discussing values 3 times higher, and potentially 10 times higher in the future. But the most important part wasn't the prediction. It was the behavior that followed. What the elites actually did. According to the narrative, Epstein and Maxwell didn't ignore the advice. They acted on it. They began accumulating physical silver, and not just metal. They also bought shares in silver mining companies. One of the names mentioned specifically was First Majestic Silver. Now ask yourself, if someone truly believed the system was stable and the market was fairly priced, would they quietly accumulate physical metal? Or would they stay in traditional financial assets? The implication here is clear. The insiders didn't trust the paper system. They were positioning for a break, a systemic event, a moment when paper promises would fail, and physical metal would matter more than contracts. The core idea, a vulnerable system. Let's strip away the personalities and focus on the structure. Because the real takeaway from this alleged email isn't who wrote it, it's what it described. The silver futures market works like this. Contracts are traded in massive volumes. Each contract represents a certain amount of metal. But only a small percentage of those contracts are ever settled with actual silver. Most are closed out before delivery, rolled forward, offset, or settled in cash. That's the foundation of the system. And it works, as long as confidence remains, as long as people treat contracts like the metal itself. But if enough participants say, "No, I don't want the paper, I want the silver," the math changes instantly, because the amount of paper claims can be many times larger than the physical inventory available. And that's what Bernard was pointing out. A squeeze isn't about price, it's about delivery. If someone, or some group, begins taking a large percentage of contracts to delivery, they start draining the system, vault by vault, shipment by shipment, ounce by ounce. And once physical inventory gets tight, the paper market loses its anchor. Fast forward to 2026. Now jump ahead from 2011 to early 2026, because according to this narrative, the theoretical squeeze Bernard described is no longer theoretical. It's happening in real time, but not where most people are looking. Not on Wall Street, not on financial TV, not in Western futures markets. It's happening in the East, through government policy, through industrial demand, through national level accumulation. And the first major sign of this shift came from Shanghai, the Shanghai Zero Lots rule. In February 2026, the Shanghai Futures Exchange quietly made a rule change. On the surface, it sounded technical, routine, just another regulatory adjustment. But when you look at the details, the implications are enormous. The new rule stated Any participant without a government-approved hedging quota would receive 0 lots in delivery allocation. 0. That means if you are not an approved industrial entity, you cannot take physical delivery, no matter how many contracts you hold. No matter how much money you have, no matter what the market price says, if you are not on the government list, you get nothing. What that really means. Think about the message behind that rule. In a normal market, anyone who holds a delivery contract should be able to receive the underlying asset. That's the entire purpose of a futures market. But under this rule, delivery is no longer universal. It is rationed, controlled, directed. And who gets priority? State-approved industrial giants, solar manufacturers, defense contractors, electric vehicle supply chains, strategic sectors, private investors, speculators, foreign funds. They are effectively locked out, which leads to a powerful conclusion. This is not just regulation, it's rationing. And rationing only happens when supply is tight. If there were unlimited silver available, there would be no reason to block delivery, no reason to restrict access, no reason to prioritize certain buyers. The rule itself becomes a signal that physical inventories are critically depleted. In effect, the state is preventing a bank run on silver, making sure the metal goes where it's considered strategically necessary, not where the market might send it. And that brings us to the next piece of the puzzle, because while China is locking down supply, another major nation is aggressively absorbing it, at a scale that could reshape the global market. In the next part, we're going to look at the Indian demand shock, the massive ETF inflows, the drain on global inventories, and the 45-year technical pattern that some analysts say could push silver into an entirely new price era. Because if the squeeze Bernard described in 2011 is finally unfolding, then what comes next? Could redefine the silver market for a generation. Now, here's where the story takes a dramatic turn. Because while China was locking down its silver market and restricting who could take delivery, another country was doing something very different. It wasn't restricting demand, it was unleashing it, at a scale that few people in the West fully understand. The Indian demand shock. In January 2026 alone, Indian silver ETFs added 13.5 million ounces of silver. That's in a single month. But the real shock comes when you zoom out. Because in December 2025, those same ETFs added another 23 million ounces. Put those 2 months together, and you get a total of 36.5 million ounces of silver, absorbed in just 60 days. Now here's why that matters. Global silver mining supply is finite, and when one country alone absorbs that much metal, it changes the entire balance of the market. That 36.5 million ounces represents roughly 5% of annual global mine supply from one nation in just 2 months through investment vehicles alone. And this isn't industrial demand, this isn't solar panels, this isn't electronics. This is investment demand, capital flowing into silver as a store of value, which means something important is happening. India isn't just consuming silver, it's accumulating it at scale. The whale Bernard warned. Remember what the banker Rene Diaz Bernard allegedly said back in 2011. He warned that a squeeze becomes possible when someone takes delivery of a large percentage of the contracts. In other words, dies when a major buyer starts draining the system, taking real metal, not paper claims. According to this narrative, India is becoming that buyer, the whale, the entity absorbing supply faster than the system can replace it. And here's the key implication. When silver flows into ETFs, it doesn't just sit in the trading system. It gets pulled into vaults, locked away, removed from circulation, which means those ounces are no longer available for delivery elsewhere. Not for London, not for COMEX, not for industrial users. They're gone, at least for now. And when you combine that with China's delivery restrictions, you begin to see the bigger picture. Silver isn't just trading anymore, it's being strategically absorbed. The East is accumulating, while the West is still trading paper. The structural shift for decades. Silver was treated like a commodity, something you trade, something you speculate on, something that moves up and down with the business cycle. But now, according to this thesis, silver is transitioning into something else, a monetary asset, a strategic resource, a metal that governments and large institutions cannot afford to be without. And that shift is showing up in the long-term charts. The 45-year supercycle pattern. If you step back and look at silver's price history, you see something remarkable, a massive formation spanning more than 4 decades. It begins with the 1980 high, the famous silver spike during the Hunt brothers era. Then comes the long decline, the stagnation, the consolidation, then the next major peak, in 2011, during the aftermath of the global financial crisis. And now, some analysts argue we are seeing the final breakout phase, the completion of a 45-year cup and handle formation. In technical analysis, that kind of pattern is not minor. It represents a generational setup, a structure that builds pressure over decades before a final move upward, and the price targets being discussed are not small. A conservative projection points toward $300 silver, but when adjusted for inflation and currency expansion, some estimates move toward $1,000 per ounce. Now, whether those numbers are realistic or not is a debate, but the underlying idea is clear. Silver may be shifting roles from industrial commodity to monetary asset. The 1970s parallel supporters of this thesis often point to the 1970s gold market because the pattern looks similar. Back then, gold surged dramatically, then crashed hard, shaking out weak hands, destroying speculative positions. Many people thought the bull market was over, but it wasn't. That crash turned out to be a midpoint, a pause, before gold exploded higher into its final peak. And according to this narrative, silver's recent drop to around $80 may be playing that same role. Not the end, but the reset. Before the next major leg, two forces converging. So now we have two powerful dynamics happening at the same time. On one side, China is restricting delivery, prioritizing industrial use, effectively nationalizing supply. On the other side, India is absorbing massive quantities through investment demand, pulling physical metal out of the global system. Both forces lead to the same result: less silver available in the open market, and when physical supply tightens, the paper market eventually has to adjust, because paper contracts can promise silver, but they cannot create it. The verdict: the squeeze is no longer theory. According to this narrative, the silver squeeze is no longer a hypothetical event. It is already happening. It is happening through government policy in China, mass investment demand in India, structural deficits in global supply, and decades-long technical patterns reaching their final stage. The concern now is contagion, because if physical inventories are tightening in the East, the same pressure can spread to Western exchanges. And if that happens, we could see delivery delays, force majeure declarations, or even restrictions on physical redemption, not because of conspiracy, but because of simple math. More claims than metal. The opportunity window. Right now, there is still a gap between paper price and what some analysts believe is the real long-term value of silver. If the structural thesis is correct, that gap represents an opportunity, but also a window, and windows don't stay open forever, because once the physical metal is locked away and delivery becomes restricted, price may no longer be the deciding factor. Availability will be. Final thought. Back in 2011, an insider allegedly warned that the silver market could be squeezed if someone took delivery of enough contracts. 15 years later, governments are restricting supply, nations are absorbing metal, and long-term patterns are reaching their breaking point. So the real question now is simple. Are we watching the final phase of a decades-long squeeze, or just another cycle in a volatile market? Because if physical silver continues flowing east, and paper claims remain in the west, the balance between the two cannot last forever.